I talked about Laura having shares in my newly formed company, Coalesco Hotels Limited. But what happens if I actually wanted to gift shares to employees? Well, that's a different set of rules again, I'm afraid. So we talked about the fact that I couldn't give shares to my children because that triggered a capital gain. But there's actually a couple of ways, potentially, of gifting shares to employees that don't trigger capital gains. Not my complete area of expertise, but if I did want to do it, either now or in the future, the two options that we would be talking about would be to have an employee benefit trust. So by issuing shares into a trust and doing some fancy transfers, we might be able to get around that capital gains tax. Actually, since the 1st of September 2013, we have been able to issue new shares to employees or new recruits, them not pay for them, and them give up their employment rights. So they have a term, they're called employee shareholders. Imaginative. But it means that they give up certain employment rights. And by giving up those rights, they qualify for capital gains tax relief on those shares that we gift to them. So if you have got people within your team that you want to incentivise and make them shareholders of the company, there are options available to you. There's a few limits in place in these areas. Why would I want to do that? Well, Laura keeps asking for a pay rise, it's terrible. If I give her a dividend of £5,000 a year, if she doesn't have any shares held outside of her ownership of Coalesco Accountants Limited, that's tax-free money to her. So that's a bit more of a negotiation tool, whereby maybe our salary would come down to get that £5,000 dividend. I'd have no employer's national insurance contributions to pay on her salary at that higher level because I've dropped her salary to pay her dividend. And also, as we all start talking about pensions in the world of auto-enrolment, only her salary qualifies for pension contributions, not dividend income. Okay. Shouldn't have brought her with me, should I? Okay. Right. So, in all of the examples that we've used today, we've talked about paying a director a salary of £11,000. A small piece of information that came out of the emergency budget and has been written into the Finance Act to apply from the 5th of April 2016 is the fact that there's been changes made to the employment allowance. Now, what you will see for anybody, well most people, 95% of people, where we run the payroll, we pay you a salary of £10,600 per annum. It uses up your personal allowance. But the amount of money that we pay you is greater than the lower earnings limit. So at the moment, this month and the next 2 months, you're all paying a little bit of employees' national insurance contributions. The dynamics of how that works against the corporation tax means that we're saving you money. You're paying less tax overall by taking the salary of £10,600. And we can do that because you're actually not paying employers' national insurance contributions. Because in this year, we have a £2,000 employment allowance. So nobody's paying class 1 employers' national insurance contributions in a small business, or in a larger business, we get £2,000 tax-free before we pay. Mr. Osborne put pay to this, and what he said was from the 6th of April 2016, where a company has a sole employee that is a director, the employment allowance reduces from £2,000 to 0. So if any of you in the room where we're paying you a salary, what you're going to see is we're going to cut your salary from the 6th of April. So when you get your April salary, you'll see it's gone down. That only applies where we have a director-only employee. Where you employ one person or more, the allowance isn't £2,000 this year coming, it's £3,000. Maybe time to employ the child, the next door neighbour maybe. Okay, will you put my bin in each week for £2 and I'll put you on my payroll? It's actually going to save me a hell of a lot of tax, isn't it? Scary stuff. The cost to the one director one director employee company, of that change means that you'll pay an extra £588 in corporation tax in the coming year. That was nice. For those of you that we do your payroll administration for, don't worry about it. On your April run, as I say, we'll just make the most tax efficient choice for you. So, what happens if I have a salary or a pension from another source? Traditionally, if you ever said to me, I'm running a limited company, I'm running it part-time, I don't have much in terms of profit, what shall I do about taking the money out of the company? The answer has always been, take it as a dividend, it's tax-free. I'm not going to say that from the 6th of April 2016, am I? So what we have in our notes is we have an example where we've got a profit of £15,000. I've got a sole director employee, and I want to know how I extract that money from the company. Well, as a sole employee, I'm going to have to pay employers' national insurance contributions. So if I took a salary only, I could take a salary of £14,150 and the remainder of my profit would have to go to HMRC as employers' national insurance. I've just lost my employment allowance. I wouldn't pay any corporation tax, I'd have no money for a dividend distribution, and depending if I was a higher rate or a basic rate taxpayer, I would either come away with £10,859 or £7,759, depending on what other sources of income I had, as to what level. Dividend is always the top slice. If I went down the route as I would have ordinarily said of pay the corporation tax at 20%, take the remainder as dividends, what we can see is that's still more advantageous, either 11.4k or 9.7k would be retained. What we're actually finding is paying a salary below the lower earnings limit, so £8,000, saving but paying some corporation tax and taking the balance of my earnings as a dividend to use that new nil rate band is the way forward. So if that's the situation, I know your situation is a little bit more complicated than that, Chris, that you were alluding to, but we can do the maths, but it starts to give you the idea that it's time to start mixing it up, looking at your relevant situation. If that's relevant to you, do the maths, let's work it out, see what it's going to cost us in the one of three ways that we've just looked at. You know that a passion of mine is rental properties. What is the interaction between my profits from my rental property and my dividend and salary from my company? Well, in your notes there's a table that shows that basically, as you've gathered from the whole discussion so far this evening, the amount of money I'm going to take home is going to reduce. As a basic rate taxpayer, on the example of making a profit from a property of £5,000, taking a dividend and my salary from the company, my retained earnings are going to drop from about 38.6k to 37.5k. As a higher rate taxpayer, as you can imagine with 32.5% tax, that drop is even more. In your notes, there's a new line appeared. The very last line says the 5th of April 2017, and the rental property profits aren't staying the same as £5,000, they've gone up to £6,000. I wasn't going to have all of you in the room and not take the opportunity to cross-sell our next event. Our next event is back here on Tuesday the 8th of March at 17:45 prompt. There's in your packet, Appendix A, is a link. If you've got a rental property and you don't understand why your profits as a higher rate taxpayer are going to perhaps look more like 6k than 5k, can I suggest your name is on our list tomorrow morning as an attendee? Mr. Osborne didn't only decide to tackle the small business in the Finance Act, he decided to challenge the private landlord as well. As a higher rate taxpayer, or even a basic rate taxpayer, you will find from the 5th of April 2016 your profits increasing. One of two reasons why, or both reasons why: wear and tear allowance disappears, mortgage interest relief is going to be restricted. If you don't know the details, you will do if you come back. Okay, before tax planning session 3, do I have any questions on what we've talked about so far? Glenn.
Just one, you mentioned a single director company, and then you talked about having employees. What about a double director company? One of those an employee.
Okay, I purposely avoided that subject. Thanks, Glenn.
You're welcome.
Interpretation is subject to much discussion at the moment as to whether 2 directors is okay and 1 director isn't, or whether whether 2 directors is okay or not. So leave that with me to be confirmed as days pass and accountants argue more and more on forums, okay?
Can you consider 2 directors with their family members as well then, please?
It will always be the answer in this room, Peter, yes, that's fine. Okay, we might be taking some directors off of companies there before the 5th of April, I fear, unless we want to pay them £10,000 and pay Section 455 tax, maybe.